Wow, ladies and gentlemen, Tom Lee went on CNBC this morning, really this afternoon, and shared some things with us. Now, I think he has an incredible take on the situation. I'm almost perfectly in sync with Tom Lee, or Tom Lee's in sync with me, because what he said here in this clip that you're about to hear is almost exactly word for word what I've been saying. He talks about the consumer. As long as the consumer stays healthy, then, you know, we're going to avoid a recession, and there's upside to earnings. Some of these China trade deals and with other countries, maybe exports get stronger. That could be an upside to earnings as well. He also talks about the Black Swan event that we've seen in April, the 20% decline, and the way that we've actually recovered that is a very bullish sign. He talks about the UMich survey that has quote unquote bananas level inflation expectations versus the actual inflation. If we don't see that inflation materialize, then a lot of the fears need to subside in this market of inflation itself. JP Morgan, as one firm, believes the soft data, well, the hard data will catch up to some of the soft data. That the soft data is just leading, and then we're going to see inflation. We're going to see a weaker labor market. We're going to see weaker growth. And Tom Lee says we may not see those things. Ladies and gentlemen, this is a great clip. Take a listen to this and let me know your thoughts on it afterwards, and then we'll break it down a little bit more in depth.
Today's pullback comes after a standout week for the bulls, of course, which saw the S&P jump more than 5%. Joining us here at Post 9 is Tom Lee, Fundstrat Global Advisors Head of Research and Fundstrat Capital CIO. Happy Monday, Tom. Good to see you in.
Yeah, happy Monday.
You really haven't been unnerved by anything since Friday night, have you?
No. I don't know if there's much signal in the downgrade Friday, because I think the first AAA downgrade was signal from 2011. I don't think Moody's had any information that we didn't have on Friday afternoon. So I think markets should realize the bond market largely priced in the fact that the U.S. is really not AAA anymore. So I'd be viewing this as a buying opportunity.
That said, you're not discounting the notion that the vigilantes have been reawakened a bit?
I think everyone should be aware the U.S. has an unsustainable path for debt, but I think the real signal will be when an auction fails. That happened a few years ago, and then we realized that was the time to really pay attention to the fact that we have debt sustainability issues. But I think a downgrade itself, I don't think it makes this much signal.
So we reclaim the 200-day. Is that a clear path to a new high, as some of the trading desks suggested this morning?
Yeah, in fact, I think today will be an interesting test. I'm assuming today's pullback's going to be really shallow, might even close positive, because most investors rage sold at the bottom in April, and then they doubted.
I hadn't heard that.
Yeah,
that's a good one. Is that your own, or have you heard that other places?
I've heard that. Yeah,
rage sold.
Yeah.
Sorry, go ahead. Continue.
And so as the markets climb, a lot of people sort of doubted, thought it was a rally that would fail, and so I think there's $7 trillion cash on the sidelines, enormous skepticism from our institutional clients, and a lot of folks sort of bet outside the U.S. So I think there's going to be a lot of chasing into year-end.
Although, a lot of shorts have been covered already, though. A lot of the hedge fund guys who actually got it wrong and rage sold, to your point, are in a very different position right now in terms of positioning.
Yes. No, and there's a difference between being short and versus having positive beta to risk assets. So I think most people might be flat on their books. But if the market is above its 200-day, showing this sort of impulsive buying, and you're flat, that means you're underinvested.
How are you evaluating potential changes in tax policy? Obviously, the market has been very reactive to any headlines on tariffs. What about this one?
In fact, I think as we start to think about 2026, and it makes sense because we're in the mid-year, there is not only tax policy that can be a tailwind, it looks like it's going to be, but it's deregulation.
Sure.
I mean, several published pieces show that regulatory cost for U.S. companies is over $2 trillion, maybe as much as $3 trillion. It's a bigger deal than the tax cuts itself.
Yeah, obviously we've been waiting for some time about the regulation. So in this environment, the ever bullish Tom Lee, what are you looking at when it comes specifically to the Magnificent Seven? We watch those so carefully, but the NASDAQ, of course, under pressure here today.
We think the Mag 7 is going to lead into year end because it's a group that fell first. It was widely owned, but it really got washed out. I think Tesla was a really good sort of case study. So I think the Mag 7 is going to reclaim its old highs. That's, of course, why the S&P should regain its old highs and of course, actually move above that before year end.
And what about financials? That's obviously an area that so many people were looking to early on. Is that still on your radar?
Yeah, financials are important. You need the banks to rally. They have been. If I was going to make a case for multiples, expanding financials is one place because not only did they prove themselves actually pretty resilient during Fed hikes and during this turmoil, but they're kind of more tech-intensive companies with better credit profiles, so I think multiples should go up.
If we do revisit the highs, what needs to happen to push past that? I mean, how firm of resistance will it be?
Well, I think investors have to look past tariffs because if we're only trading tariff headlines, the markets are going to be range-bound. But again, as I look at 2026, I'm looking at companies that are battle-tested. They survive the tariff headlines. There might be freer trade. That's an upside to earnings.
Freer trade than we thought.
Yes, than we thought, yes.
But the earnings estimates have come down, have they not?
Yeah, but they're going to flex in both directions, meaning I think if we have deregulation, possible improved ability to export, tax cuts, that actually all supports higher earnings. But I also think the multiple for the S&P should be going up because, again, we've taken away a black swan event. I mean, we did, the February to April period was a black swan for stocks.
Do you think the downgrade hurts the push for tax cuts?
I think it's going to have almost no effect.
No effect?
Yeah, because at the end of the day, the bond market prices what they think the rating should be.
I don't mean from the market standpoint. I mean from the political optics standpoint.
Yeah, it might, but at the end of the day, the U.S. really wasn't AAA anymore because it was only 1 out of 3, so it's like not even a split rating, AAA.
So, Tom, is there anything out there? I mean, and to be fair, you've been bullish throughout. You were right during this period when a lot of others sort of, whether they rage sold or just got upset in general. But what, if anything, is top of mind for you in terms of concern?
Well, I think the most important is the consumer has to stay healthy because right now we're seeing this huge divergence, right? Like the UMich survey show banana level inflation expectations, but the realized is low. If the consumer gets super cautious and retraces, then we have a recession. So I think it does come into consumers have to stay confident and keep their jobs.
And so you're a believer in the data versus the sentiment?
Yeah, at the moment, this divergence between inflation and realized is actually the largest I think ever recorded for UMich. And so I would say as long as inflation doesn't explode, then the consumer has marginally a chance to become even more positive.
Wow.
Yeah, a lot of your former colleagues at JPM think that the hard data will catch up to the survey work.
Yes. And I'm paying attention because, of course, JP Morgan, they do a lot of homework and they've got credit card data, so we do have to watch it. Sure. So we just have to hope for the best.
Tom, always. Good to see you. Thanks.
So, again, I think all of that was hopefully insightful to you. And I think Tom Lee's correct. If we're just trading the tariff headlines, we're going to stay in a range. But inevitably, I think we're going to break out of these new all-time highs and probably see a 20% rally into year end. Okay? I know that's crazy. Even Tom Lee would probably call that crazy at this point or far-fetched. But I don't believe we're going to see inflation. I believe in my core, as someone who interacts with consumers on a day-to-day basis and average people, that if COVID didn't scare people into systematically starting to save more money, if the great financial crisis did not systematically encourage people to save more money, or the inflation we've seen in 2022, nothing is going to. Okay. Now, what I mean by this is you can look at Japan for an example. Okay. Japan's stock market, as we all know, went in a bubble in the 90s. And really what that was consumers in Japan started spending a lot more money, right? What happened? The bubble burst. Times got tough. Japan started saving a lot more money, like the actual citizens. They stopped spending. They started saving. Well, that's a problem for your economy when that happens, okay? And that's why Japan's stock market took like 30 years to hit a new all-time high. Okay, but that was a systemic change in the culture of Japan, going from being more consumption related to less consumption. Okay. I don't think it's ever going to happen in America. Just knowing average people, they're always going to spend all of their money. Okay. In aggregate, like less than 50, like 50% of the population doesn't have $400 to their name. Okay. For an emergency expense. People live paycheck to paycheck in this country. Even if people make more money, like they will still live paycheck to paycheck, right? In aggregate. Why is that important? Because it comes back to the labor market. The only variable that will change consumer spending behaviors is whether or not they are employed. Okay. Now, inflation can also do that, but you have to understand, inflation is a byproduct of money printing. It always is and always will be. Why? Okay. Inflation is not supply chains. Inflation is not the Fed. Inflation is the government. It is money printing and giving out free money. Okay. That is inflation. Okay. Why? Well, imagine it like this. If you make the same amount of money this year, next year, the year after that, blah, 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 and let's say a month from now, your, $5 bag of Doritos that you love to buy, you have to have them, you always want them, right? Goes to $7. Okay. You will still buy that bag of Doritos, but less often. So from a company perspective, raising prices really just destroys demand. In an environment where the money supply is stable and call it stagnant, right? Wages are stable. In an environment where, let's say, the bag of Doritos goes to $7 and maybe normally you get $500 a week on your paycheck. But in a month from now, you get $700 on your paycheck. That $7 bag of Doritos doesn't feel as bad anymore. Okay. So it's called demand destruction. You can read into this if you would like, but the more companies raise prices without the offset of more money out in the economy and more money in consumers' pockets, the more demand destruction you will see. Every cent, every dollar, every $10 a product is raised, you will see demand destruction. Okay. If it's not offset by more money supply. Okay, that is why inflation is always a monetary phenomena. Okay, it always has to do with the money supply, nothing else. Because if prices just go up in stores and nobody has any more money, people are gonna not buy as much, and then companies are gonna have to idle factories and then lay people off. It's like, would you rather eat a little bit of inflationary, impacts, tariffs, whatever taxes in the margin? Or raise those costs, pass it on to your consumer, probably lose market share to someone who doesn't need to do that, sell less as far as units, and potentially get further behind your competition? No. Okay. So I could probably make a 30-minute long video on this. Long story short, we're not going to see this inflation that people are predicting. Wall Street will have to get more bullish on stocks, and markets will move higher. That's my thought. That's my view. As long as we don't see some kind of crazy money printing phenomena, stimulus checks, if we start to see that, yeah, all bets are off. Inflation's coming back. Okay. But until we see stimulus checks, free money going out to people, I'm not worried about inflation at all. Could you see a little bit of inflation? Sure. Tiny bit? Sure. Who cares? It's not going to hurt the economy from a recessionary perspective. It's not going to change the thesis on markets. I wouldn't expect that kind of inflation. So, from kind of the same viewpoint as Tom Lee is saying, you kind of have to make your mind up now. Do you think these things are issues or not? If you think they are, then I probably personally wouldn't be in the markets. I don't think they're going to be issues, and I think we're going to see another 20% higher in markets into year end. That is why I am currently heavy in stocks, heavily positioned in stocks ever since the the March 7th, April 7th low, went all in around this period. Okay. And I think there's a lot of positive things going on right now that nobody even wants to talk about. By the time they're talking about them, they're priced in and it's too late. So I encourage you to think for yourselves. This is not financial advice. This is not a recommendation. Come to your own conclusions, whether you want to be in or out this market or how you want to be positioned in this market. Because I believe once you blast through those all-time highs, the next 6 months are going to be pretty aggressive to the upside. Just, again, my thought. Let me know your thoughts on this down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.